This is MacroVoices, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Eric Townsend and Patrick Ceresna.
Eric, it was great to have Louis back on the show. Now let's get to that chart deck. Listeners, you're going to find the download link for the post-game chart deck in your Research Roundup email. If you don't have a Research Roundup email, that means you have not yet registered at MacroVoices.com. Just go to our homepage, MacroVoices.com, and click on the red button over Louis' picture saying looking for the downloads. All right, Eric, let's start off with the equities. What are your thoughts here?
Well, Patrick, the overarching market big picture this week, of course, is President Trump surprising everyone yet again with the weekend news that China and the U.S. are now going to have a 90-day ceasefire in effect on tariffs. Patrick, as I contemplate all of the different responses that I've heard to this news this week, I think our friend Michael Every is probably the most prescient commenter that I've seen, at least what he said on X, which I'll summarize as basically, for heaven's sakes, people, the only sensible move here is to assume that the volatility and turbulence has only just begun and that there's another wave of it coming. What that wave is it up or down, or what's it going to be? We don't know, but we know that President Trump is not done changing things and potentially breaking a few things along the way. So I haven't turned bullish as a result of this news. I would say I'm just lamenting the realization that I need now to roll my June E-mini put spreads into September because my hedging window isn't going to be long enough now that I realize how this market is evolving. I think that the downside risk is still there in equities, but I think it's likely to take all summer to play out as opposed to happening in the next few weeks, as I had previously been thinking. Note, however, that all of this seems to change about every weekend or so when we get the latest surprise news as to what President Trump did for his weekend adventure. So let's see what next weekend brings, and maybe it'll all be back in the other direction again.
I'm going to echo your sentiments because I do think that the time frame has now all shifted forward. Our initial analog was that this was a bear market rally and that there would be a re-resumption in the sell cycle. And often bear market rallies would last about 1 to 2 months. Now that we've seen this entire period kind of ease off on the pressure on the market, and more importantly, that we've beaten a lot of the key technical hurdles, this puts the market into a neutral zone, one where the dominant sell cycle that doesn't have this negative feedback loop that just creates selling begetting more selling and distribution. So now that we're up here, the market has almost got to go through another little topping formation rolling over. The likelihood of a double top retest is entirely on the table, and but will we see something more bullish than that? I'm holding out to see more information, but at this stage, the upside of a couple hundred S&P points over the course of the rest of May is entirely plausible. With that said, my bigger picture view just hasn't changed. Ultimately, we're at a moment where the market has got to put a topping formation in, and that another bigger distribution cycle is very likely. But the risk of it coming in May and June has materially diminished, and the likelihood of it now being pushed out into that July, August, September period is much more likely. And so we just have to now change our time frames and reduce the expectations of something more bearish immediately. And we do have the option expiration coming up this weekend. Sometimes when some of that gamma gets rolled off, it could lead to some distribution. We did see an incredibly strong 2-3 week impulse. So it would be very typical to see a 100 or 200 S&P point pullback. But at this stage, that would likely only test the 50-day moving average, and more than likely the bulls will defend it on first test and create some sort of a bounce back towards the top of the range, making the month of May and maybe early June far more trade range bound than in other periods. All right, Eric, let's move on to the U.S. dollar.
Well, Patrick, the counter-trend relief rally in the Dixie that we've been speculating might be coming for the last few weeks. It's finally upon us. The question is how far it has to run before the primary downtrend resumes, which is my base case for how this happens. We go up for a while, and then we go down. Are we done going up? We still have a little bit further to go up. I'm not sure, but I think we eventually go down when this plays out. To be sure, though, the Trump tariff curveball helped this dollar bounce, and depending on how that news shapes up, whether we have any opposite direction news coming next weekend, will all contribute to what happens next. So let's keep our eye on the tape.
Well, I have that chart of the U.S. dollar index on page 3, and what you can observe is that dollar bounce came straight to the typical 50+% retracement toward the 50-day moving average in a very typical reaction to an oversold market move. This bounce now has come to that resistance level where if the prevailing downtrend it remains the dominant one, then this becomes the level where it's vulnerable for the resumption of the sell cycle back to the bottom end of this range. And so we're at this stage still respecting that the prevailing bear trend in the dollar is the path of least resistance, and at this moment vulnerability of it heading at minimum for a double bottom retest is possible. We haven't seen real bottoming formations or any basing formations that are very typical evident before a trend shift. And so at this moment, we're going to respect that prevailing downtrend. All right, Eric, let's move on to crude oil.
Well, Patrick, it looks like the rally in WTI crude may be stalling out right around the 50-day moving average, which is coincidentally around the same level as the April highs, right around $64. Patrick, what do you make of the chart?
Well, Eric, technically, that sell-off that we had the other week that brought us for a direct double bottom retest of the low was had all the opportunity of breaking down to the low 50s, even $50 on the downside. Rather, it bounced off that previous support and completely erased the last round of selling in one fluid motion to the upside. This starts to resemble that of a double bottom formation. Now, are we above the 50-day moving average? Have we seen a new bull trend forming? No, but we are 900 basis points off of that low, and now we're in a situation where if the market stops making lower lows and we start seeing accumulation forming, if we see a breakout into the mid to high 60s above that 50-day moving average, this might be the first bullish price action that we've seen legitimately in oil in over a year. Will that happen is the puzzle to solve, and we'll be watching over the next couple of weeks how this plays out. All right, Eric, on page 5, I have that chart of gold, and this is reversed quite a bit. What's your thoughts here?
Well, Patrick, it's make or break time for gold with Wednesday's close right on the must-hold levels, technical levels just below 3,200. So what we would expect to happen from here is either we should see a reversal, a bounce higher, or we should see an acceleration of selling to the downside in the case of a failure at this key support level that we're on. We'll probably know by the time you hear this podcast on Thursday, 3,200 was the key pivot level. We're likely to have moved considerably beyond that number in one direction or the other by the time you've heard this podcast in the next day or two. That's going to be the tell for the next leg in the market, whether or not that key support held just below 3,200, right around 3,175, 3,180 on the June delivery contract.
Yeah, the 3,200 level is very interesting on the short term. It's the 50-day moving average. It's also where the 61.8 retracement of the April rally lies. Now, if the bulls can hold this area and get this back above 3,300, then the prevailing bull trend remains intact. But that's got to really hold here and now. Now, let's go talk about the other scenario, the scenario that we're going to entering some sort of a big overdue market correction to the downside. Well, Here we have gold having done a double top retest. And if we turn around and have a breakdown below 3,200, then a typical market correction would last 1 to even 2 months in length. And we could see retracements all the way down to 2,900 to 3,000 on the downside. Now, that in itself, I don't think would be a new bear market. That would simply be the gold market pausing after a very extraordinary 6-month run on the upside. And so it consolidating, staying at or around 3,000 for a month or two would simply reset the very overbought conditions in gold and create the next key buying opportunity. But will that correction now happen? It's all about this 3,200 level you just talked about. So let's see what happens over the course of the next week. All right, Eric, let's touch on uranium.
Well, Patrick, we're finally starting to see positive nuclear news flow produce positive market reactions, and that's a welcome change as far as I'm concerned. Seems like the hate for uranium is finally gone. I hate to call bottoms because you're just asking for trouble, but sure feels to me like the bottom is in, and we've at least seen a substantial new move here. I think that if we had broader market risk-on event, that could be the one thing that might turn this around and get us to still a new lower low. But I don't think that's going to happen, Patrick, because it seems to me like finally the market is waking up to the news flow and just how bullish the outlook is for nuclear energy in coming years.
Well, Eric, for months we've now been talking about how the downside selling pressure has subsided in uranium, and that essentially we found a base from which uranium has kind of stabilized, and all that aggressive distribution has already been washed out of the market. So now we have a situation where is this now turned into a bull market? Is this where the basing or bottoming formation develops for the next bullish impulse? Well, look, we are getting above the 50-day moving average on the Sprott physical on page 6. This is the first sustained bullish breakout like this since September of last year. Now, September of last year was a false start. And so the bit puzzle to solve here is that will we see this kind of a breakout lead to a new accumulation cycle? We've got the spot U308 up in the 70s again. And so we're getting a little bit of momentum. A lot of uranium stocks having retraced materially off of their worst levels. What's going to be really interesting to see is that inevitably some sort of a short-term market correction is likely to get underway. And when it does, will we see that it is bought on dip and that it doesn't make lower lows, and we see the types of accumulative patterns that potentially we're seeing the turning point in that market.
Patrick, you have a chart of the 10-year Treasury note in this week's chart deck. Walk us through it.
Right, Eric. So on page 7, I have the 10-year Treasury note, as well as on page 8, I have the 30-year Treasury note. And it's important to highlight how incredibly weak the bond market has been. And when we're thinking about where potential market vulnerabilities can exist, it's often in those areas that nobody is really focusing on or watching. In fact, there's a lot of people that generally are in the camp that bonds should be bullish in this environment, and certainly at these kind of yields, making these bonds attractive. But we continue to see U.S. fiscal imbalances worsening, and yet the Treasury bond markets are, especially on the long end of the curve, continuing to distribute. And we're now looking to see whether or not this is just going to be a trade range, or whether we're going to see a new downtrend emerge here in these. Now, we've certainly had the basis trade throw a curveball into the bond markets, and now the question is this something that starts to feed back on itself in a negative feedback loop that causes yields to go spiking higher, and maybe that in itself could be a shock to the markets that nobody sees coming. This is not something I'm predicting, but rather something I'm watching, and we're going to see whether or not this becomes a story or not in the coming weeks.
Folks, if you enjoy Patrick's chart decks, you can get them every single day of the week with a free trial of Big Picture Trading. The details are on the last pages of the slide deck, or just go to bigpicturetrading.com.
That concludes this edition of MacroVoices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. MacroVoices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at macrovoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Eric Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit MacroVoices.com.